Are you ready to seize the moment in the financial world? In today's episode, we delve into the skyrocketing gold market with Ronald-Peter Stoeferle, predicting gold prices to hit $4,800. Eric Basmajian warns us about the looming housing crisis with supply levels not seen since 2008. And don't miss Andrew Beer's insider tips on leveraging hedge fund strategies for your retail investments. Subscribe now to stay ahead of the financial game. Today, on Financial News and Review, we will summarize the following videos. From Adam Taggart, Thoughtful Money, we have Tap into the Same Advantage That Hedge Funds Do, Andrew Beer. From David Lin, we have BS warns of debt crisis, gold to rally 100% to $4,800, Ronald-Peter Stoeferle. From David Lin, we have How High Will NVIDIA Shares Go? CEO Jensen Huang sells 120,000 shares will Rhind. From David Lin, we have Housing Supply Highest Since 2008. What's Next for Prices? Eric Basmajian. What's up, Thoughtful Money followers? Today we've got a stellar episode lined up with none other than Andrew Beer, co-founder and managing member of DBI. We'll be delving into the mystifying world of hedge funds and discover how you can tap into the same advantages hedge funds do, without needing a net worth that makes your eyes water. Andrew's here to demystify hedge funds and show how retail investors can benefit from hedge fund strategies. Andrew Beer believes that hedge fund strategies, particularly managed futures, offer significant advantages for retail investors. By harnessing these strategies in a cost-effective, accessible manner, investors can gain diversification, reduce portfolio risk, and potentially achieve superior returns without the high fees and restrictions traditionally associated with hedge funds. Here are the key points discussed by Andrew Beer. Managed futures. Managed futures is not as scary or complicated as it sounds. Think of it as the secret sauce that hedge funds use to complement stocks and bonds. Historically, managed futures have no correlation with stocks or bonds, making them an excellent diversifier. In crucial periods like 2022, the Great Financial Crisis, and the dot-com crisis, managed futures performed exceptionally well, often when stocks and bonds did not. Hedge fund industry critique. The hedge fund industry is notorious for its high fees, with some funds charging up to 10%. Most hedge funds today don't offer the same attractive returns they did in the 1990s due to increased size and complexity, leading to diluted performances. There is collusion between hedge funds and consultants who have no incentive to recommend simpler, cheaper investment solutions. Accessibility of managed futures. Andrew's firm, DBI, offers the DBMF ETF, a cost-effective way to access managed futures with only 85 basis points in management fees, far lower than traditional hedge funds. These ETFs replicate the strategies of top hedge funds, but pass the savings on to you, the retail investor. Andrew Beer made the following predictions. Adoption of managed futures. Andrew predicts that managed futures will become an essential part of investment portfolios over the next decade, moving from a 60-40 stock-bond split to something more like 50-30-20. Increased market volatility. With global uncertainties, economic volatility, and AI disruptions, Andrew believes we will see more turbulent market conditions, wherein managed futures will shine as a stabilizing force. Beer wraps it up by emphasizing the importance of diversification in an ever-volatile world. With traditional 60-40 portfolios potentially outdated, incorporating managed futures through accessible ETFs like DBMF could help everyday investors sleep better at night while growing their net worth. And remember, always diversify, keep costs low, and invest wisely. Welcome to another exciting episode on the David Lin channel, where today's special guest is none other than Ronald-Peter Stoeferle, managing partner at Incrementum AG. He's not just any guest. Ronald is renowned for his expertise in precious metals and market analysis. Today, we're diving deep into the prospects of a skyrocketing gold market, potential impacts of debt crises, and a whole lot more. The video's thesis posits that gold is set for a meteoric rise, potentially reaching $4,800 by 2030, driven by factors such as central bank demand, global economic conditions, and looming debt crises. Ronald emphasizes that we are in the early stages of a bull market for gold, with various macroeconomic trends favoring a substantial increase in gold prices over the next few years. Here are the key points discussed by Ronald-Peter Stoeferle. Gold market dynamics. Gold has reached new all-time highs, recently surpassing $2,400 an ounce. Despite rising real interest rates and declining Western ETF investments, central banks have been significantly increasing their gold purchases since 2022. Emerging markets are playing a crucial role in gold demand, currently responsible for 65% of global jewelry demand and 50% of physical investment demand. Gold price predictions. Gold is forecasted to reach $2,665 by the end of 2024 and potentially $4,800 by 2030. Main drivers include positive real interest rates, central bank buying, and increasing demand from emerging markets. Emerging market influence. By 2024, emerging markets will produce more than half of the world's GDP. There's a biennial increase in gold demand, despite Western investors underestimating its role. Economic indicators. Despite headwinds like rising real interest rates, inflation, and a strong dollar, gold prices have remained resilient. Ronald argues that these challenges have not fully been accounted for in market sentiments. Ronald-Peter Stoeferle made the following predictions: gold market surge, a forecast of $2,665 by the end of 2024, with a bullish long-term outlook culminating at $4,800 by 2030. Factors include continued central bank purchases, the resilience of emerging markets, and unsaturated ETF demand that will likely trigger higher prices. Debt crisis. Ronald warns of a looming debt crisis, especially in the US and Europe, predicting increased fiscal instability, which might lead to a significant economic downturn. He references the recent Bank for International Settlements report that highlights growing concerns over government debt levels. Ronald-Peter Stoeferle concludes by reiterating the bullish case for gold, projecting significant price increases driven by central bank demand, emerging market growth, and unsaturated ETF investments. He warns of potential debt crises influencing these trends and emphasizes the importance of diversifying portfolios to include substantial gold allocations. For more detailed insights, Ronald invites viewers to explore the extensive In Gold We Trust report, which is available for free download. Welcome to the latest episode on the David Lin channel. Today, we're joined by the insightful Will Rhind, CEO of Granite Shares. Buckle up as we dive into the fascinating world of tech stocks, specifically focusing on the mammoth rise of NVIDIA shares and what the future holds for this tech giant. The big question on everyone's mind: can the momentum in the tech sector, especially for NVIDIA, be sustained? Rhind argues that despite recent massive gains, NVIDIA's surge is grounded in solid fundamentals, driven by robust earnings and dominance in the AI space. However, there's a broader market concern about whether this trend is too good to last. Here are the key points discussed by Will Rhind. Tech sector versus broader market. Tech giants, particularly NVIDIA, have been outperforming due to strong earnings. However, most sectors in the broader market are trailing, causing speculation about a potential end to the bull rally in tech. Interest rate changes have impacted smaller companies far more than large tech firms. NVIDIA's market leadership. NVIDIA briefly surpassed Microsoft and Apple to become the world's most valuable company. Upcoming earnings at the end of August are crucial. Can they keep up the stellar performance? Key products like the new Blackwell chips and continued demand for existing GPU lines are driving stock prices. Investor sentiment and trading dynamics. Granite Shares 2x long NVIDIA ETF VDL is seeing massive trading volumes, more than some of the biggest U.S. stocks. Overwhelming investor bias towards long positions in NVIDIA hints at continued optimism. Despite CEO Jensen Huang selling 120,000 shares, Rhind sees this as operational noise rather than a red flag. Will Rhind made the following predictions: NVIDIA's future growth. Rhind believes the AI investment boom has legs, and NVIDIA could continue its upwards trajectory. Speculations that NVIDIA's valuation might hit the $10 trillion mark in the future, conditional on sustained AI growth. Market and interest rates. With inflation indicators easing, Rhind predicts potential interest rate cuts either by the end of this year or early next year, which could shift market dynamics. Will Rhind underscores that NVIDIA's rise is solidly backed by fundamentals and continued AI demand. For those eagerly watching the tech sector, keep an eye on NVIDIA's end-of-August earnings as a bellwether. As always, don't forget to like and subscribe for more insightful content. Welcome back to the David Lynn Show on the David Lynn YouTube channel. We've got a star in the economics world who's no stranger to us, Eric Basmajian. Eric is the economist extraordinaire and founder of EPB Research. Today, he's going to drop some serious knowledge about the current state of the housing market, labor dynamics, and what the future might hold for all of us. Eric Basmajian presents a comprehensive analysis of the current economic climate, focusing on the housing market, labor statistics, and the overall health of the U.S. economy. He dives deep into why the housing supply is swelling to levels not seen since 2008, how the labor market is shifting, and what it means for future economic growth. Here are the key points discussed by Eric Basmajian. Economic slowdown and labor market. Eric predicted millions of job losses last year, and we saw the unemployment rate tick up to 4%. Job cuts were heaviest in temporary help and trucking sectors, whereas residential construction surprisingly added jobs. The GDP growth rate has slowed significantly, and real GDP grew at an annual rate of just 1.3% in Q1 2024. For a recession to be called, the National Bureau of Economic Research looks at 6 variables, and right now it's a mixed bag. Housing market dynamics. Existing homes have a very tight supply with a month supply of 3.7, while new homes show a much looser market with a 9.3-month supply. Prices in Texas and Florida, previously hot markets, are now seeing significant price cuts and homes sitting unsold. Indicators and predictions. Leading economic indicators like building permits and the yield curve are still in contraction mode, hinting at future economic struggles. Noticeable price pressure in markets with high inventory, especially new homes, likely leading to reduced new permit applications from builders. Eric Basmajian made the following predictions. Economic growth deceleration. Eric expects continued slowdown in economic growth. With GDP growth rates low and leading indicators pointing towards further deceleration, he anticipates that the economy will remain vulnerable. He believes that the labor market, especially residential construction employment, will be critical in determining whether we face a more severe economic contraction or a soft landing. Housing market future. Eric predicts that the trend of increasing inventory and price pressure will continue, ultimately slowing down new construction and laying off construction crews. Eric Basmajian emphasizes that we're headed for a deceleration in economic growth. He suggests that investors should stay cautious, particularly watching the labor market and residential construction sectors for clues. And for those in the home market, whether you're a buyer or seller, be prepared for price movements and tighter conditions in certain regions. Remember, folks, stay informed, stay cautious, and maybe keep an eye on those lumber prices too. In this episode, Andrew Beer unveils how average investors can leverage hedge fund strategies to diversify and reduce risk through managed futures. Ronald-Peter Stoeferle predicts a massive surge in gold prices driven by central bank purchases and emerging market demands. Meanwhile, Eric Basmajian highlights the housing supply crisis and its potential impact on the broader economy. Despite different focal points, all experts stress the importance of diversification and preparedness in face of economic uncertainties. Stay tuned to uncover the detailed analysis and future opportunities. Thanks for watching Financial News in Review for July 7th, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.